please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Halftime Report. Well, it's 12 noon. We're halfway through the trading session. It's as flat as can be. It's a Friday afternoon. Keep an eye out on some of these pharma stocks. That's where you're getting some green. Otherwise, it's quite a flat day. But relative outperformance, Rima, if you take a look at it in comparison to some of those Asian markets.
Yes, absolutely. Pharmaceutical is really taking the spotlight, right? From its, I'm looking at the BSE Healthcare Index. From its low in May, it's rallied close to about 12%, but it's still about 20% off from its, 52-week high. So clearly that it's covered some ground, but compared to its earlier peak or its lifetime, its highs of close to about 18,000 thereabout that it hit for, I think in 2015 thereabout. So compared to its life highs, the healthcare index is still off close to about 20-odd%.
Yeah, Rima, I was just going to make that point actually. In the last 10 days, as you said, we have seen a rally from June 5th onwards, to be precise. The pharma index is up 12%. At that point of time, we take a look at Lupin. It was trading at around 16.5 to around 17 times its FY20 EPS. Currently, it's trading at around 20 times. Why? Because it's seen such a big rally. Sun Pharma as well was trading at around 19 times, just 10 sessions back. Now, after the rally that we have seen over there, it's trading at around 22, 23 times approximately. So there's a bit of a catch-up that we have seen. Risk-reward may not be as favorable, but clearly money is flowing out there.
Yes, and with the dollar index strengthening overnight to an 11-month high, the rupee weakness, that's an additional tailwind for IT as well as pharmaceutical stocks today. But Nomura has released its 2018 Mid-Year India Market and Economic Outlook, with banks not buying into bonds and yields hardening, resulting in worsening portfolios. CNBC TV18's Ritu Singh caught up with Sonal Verma, the chief India economist, and Neeraj Gambhir, the head of fixed income at Nomura, and began by asking them what can break this vicious cycle going ahead. Listen in.
We do need some kind of, measured policy response to handle this situation, because let me just give a little bit of a context. About 40% of government bonds are being held by the public sector banks. And these banks, a large portion of these banks are currently at a situation where they have shortage of capital, and the dominant management time is going in resolving the NPA issues, right? Yeah. So clearly this is one area where they don't want further impact on the balance sheet. But unfortunately, the yield rise of last few quarters has actually not left them with any choice. So clearly they're at a situation where they need more capital, and that capital is required to deal with the NPA issues, but a large part of that capital is getting consumed towards dealing with the rising bond yields and its impact on the balance sheet. So that certainly has impacted the demand from these banks, and given the fact that we are highly dependent upon these banks to buy these bonds to a large extent, it's creating its own issues. Okay. So I think there is some kind of a policy, and some policy response has already come. Yeah. If you see the modifications in the government's calendar, if you see the RBI's dispensation to allow these banks to spread the losses over a period of time, is certainly helping. But I think a little bit more needs to be done to make sure that we don't. This does not sort of create its own issues going forward, and so that's basically my my 2 cents on it.
Okay. All right, Sonal, I also wanted to get a word in on the macro conditions. External environment was very favorable for India up until last year. Suddenly now we have threats of trade wars, we've seen rising crude oil prices, the interest rate cycle has turned. What does that mean for countries like India, and what is the outlook sort of when we start this new fiscal?
Yeah, the macro outlook globally is turning actually extremely adverse, and I think from India's perspective there are 2-3 specific issues we need to focus on and try to have like a policy defense ready. One is on the financing of the balance of payments side, clearly getting a concern its impact on rupee. Second, if there's an impact on rupee and obviously US interest rates moving up, that has an adverse impact on domestic interest rate environment. And third, if you're getting getting into an environment of more protectionism, trade growth slowing down globally, then the global macro growth impulse is going to be neutral to negative. So if we want domestic demand to be strong, how do we ensure stronger domestic demand? And fourth, if I may add, I think, the adverse global environment is happening at a time where the domestic balance sheets are still stressed, right? Yeah. So you do not want to deteriorate the domestic balance sheets even further. So I think this is sort of the challenge that we are facing right now, and needs to be a big policy priority.
In fact, we're meeting at a very interesting time. You read the ECB statements. They're going to stop their massive bond buying program. The US Federal Reserve has hiked its rates, and 2 more hikes are coming this year. What does that mean overall for emerging markets as far as the capital outflows, etc., are concerned, and India specifically?
Yeah. So the good thing is that the policy changes by the global central banks are very well telegraphed, which basically means that they are sort of making longer-term commitments about what they're going to do. There's a very well planned calendar rolled out by these banks as to how they're going to make those changes to the balance sheet. So which means that the market has adequate time to prepare for it. But having said that, we are actually coming out of almost a decade-long, very easy monetary policy cycle. Yeah. And markets are kind of used to that easy liquidity being around. Yeah. And as the central banks start winding down their balance sheets, that liquidity is not going to be around for a longer period of time, and markets need to prepare for it. There will be implications for the emerging market economies. As we've seen recently, there has been some portfolio flow reversals. The good thing is that, in my opinion, most of the emerging markets are in a much better place than they were, say, 3 or 4 years ago when something like this started. So it doesn't feel like that it is going to create a very large, very systemic problem, but certainly most of the central banks and most of the emerging market central banks in particular will have to think about as to what are the possible implications of this reversal of flow and how do you prepare for it. I think India seems to be in a much better place than in the past. Our foreign exchange reserves are pretty strong. Our macroeconomic situation is actually reasonably good. Inflation, fiscal deficit and growth all put together. So I think that I'm hoping that given the fact that it is a very well telecasted and telegraphed move, and the fact that people have had a chance to sort of deal with it, would lead to no big surprises, but one needs to be careful.
But do you think, given that scenario with the hardening bond yields, could some of the investors come back to India? We've seen 4.5 billion or more outflows just in this calendar year alone.
It's not, if you think about it, it's not a very large outflow, first of all. There's no need to be alarmed about it. Okay. If we have opened up our markets for the foreign investors, then we need to be prepared for a two-way flow. Yeah. We've seen a pretty significant inflow over the last few years. So if a bit of that reverses, I think one should be okay with it. The second part is that, yes, it is looking very attractive from a yield perspective, but we also need to look at the global backdrop. My guess is that some of this money may come back once we see a little bit more stability in the global markets, and we see some of the other things which are affecting India's macroeconomic environment, which is, for example, the crude prices and stuff like that. Yeah. Those things settle down. I think some of this money will certainly come back. One thing I want to say is that the share of Indian bonds in the global investors' hands is actually very small. So if you think about it from a structural standpoint, it can only grow. Okay. And the deciding factor will be how fast we open up our markets rather than whether the world wants to buy Indian bonds or not.
All right, Sonal, what a lot of investors, all investors would look at is stability in a country. With what we've seen with the rupee, the rising crude oil prices now impacting the economy, bond yields have been hardening. How does all of that play into foreign investors coming back here? Where do you see, the impact overall?
I think from the foreign investor standpoint right now, there is a bit of risk aversion. At this early stage, we are seeing across emerging markets actually money flowing out. But I think when things stabilize, there will be a bit more differentiation. And when there is focus more on differentiation, I think that's where it becomes important for India to sort of make a point at the emerging market scale that we are maybe different to not just 2013, but also different to where we are, relative to other emerging markets. So I think in that context, there are a few things that is important. One One is investors want to see the focus on inflation credibility from the central bank side. Second, I think it's very important for the government to send a signal that on the fiscal side, it's going to be a credible fiscal framework. We've seen a slip last year, should not see that next year. And third, a big focus on reforms, I think, would be very positive.
All right, time to slip into a short break. On the other side, we'll get chatting with the management of Make Money Organics. Stay with us.
Welcome back. Absolutely flat in the benchmark indices, so oscillating within a very well-defined and tight range for the benchmark indices. So straight away then, let's get on with our corporate radar. Make Money Organics is in focus today, as a normal monsoon will improve the prospects of the agrochemicals business of the company. Remember, this is a company which operates in three key segments. One is pigments, secondly the agrochemicals, and thirdly in the basic chemicals department. Also, the company is quite optimistic about all these three segments and expecting these three segments to grow by 15 to 20% each. Ashish Suparkar, the managing director of the company, joins in now. Good afternoon, Mr. Suparkar, and thanks so much for joining in. First, if you could tell us if the monsoon is likely, as all the indications are, what is the projected growth for your agrochemicals business?
Good afternoon. We believe that agrochemicals will have a 15 to 20% growth this year. We have internal target to grow by at least 15 to 20% this year. Same as for the pigments and same as for the basic chemicals. Basic chemicals may also grow to 20 to 25%, but pigment will be around 15%, agrochemicals 15 to 20%, and basic chemicals by 20%.
Right, Mr. Suparkar, let's take it piece by piece. Let's focus on the agrochemicals business first, sir. If you could tell us the breakup of revenues, sir. I believe that you have an export contribution as well out there. If you could give us a sense of how much of that is export, how big a difference would it make that monsoons are normal and they are arriving on time?
See, we exported around 70% of our production last year for agrochemicals, and 30% was domestic. But this is a price sensitive issue. We can sell 100% also domestic if the prices in domestic market are higher.
Okay.
So it is basically price driven, and we have registrations of agrochemicals in many countries of the world. So we try to export more of our products. So if monsoon is good, Indian prices are good, then we will sell more in the domestic market. Otherwise, we will also able to sell the products in export market. And as I said earlier, we are targeting for 15 to 20% growth in agrochemicals.
Okay. In your agrochemicals business, the heartening feature was the improvement in margins to 16%. You have already spoken about how the company has deployed windmills and thereby reduced your fuel cost. But from here on, do you see margins expanding from the 16% that you reported in FY18 for your agrochemicals business?
If the sale will grow by 15 to 20%, the margins will definitely improve because we have taken all the steps to reduce our cost of energy, cost of employment, cost of banking interest, reduce our working capital need. So that has reduced our cost, so it has increased our margin. And as we have sold more, our profitability has increased. We believe with the 15 to 20% more sales, our profit will further go up by percentage as well as by real number.
Capacity utilization levels, sir? Capacity utilization levels, sir, currently?
Currently, utilization level is around 70%.
Okay.
Okay.
We target to use up to 80% this year.
All right. Let's come to your basic chemicals business. There you have outlined a capex. There is a CMS project which is going to get commissioned. If you could give us some details on that. And caustic soda prices seem to have moderated in Q4. How will it impact that?
chloromethane project is likely to come up by the end of this year. The caustic prices have slightly moderated, but they have been extraordinarily high and they were not sustainable. All over the world, the prices of caustic have gone up, but now it has come down a little, maybe 10%, and the margin is still very good enough for us to continue.
All right, so the CMS project that comes up later this year.
The chlorine was, which was...
Go ahead, sir.
Yes. Yeah, please. The chlorine prices, which were negative since last 5-6 years, have become either zero or positive. That will definitely improve the margin in caustic soda business, basic chemical
All
business.
right, so I wanted to understand the latest updated caustic soda price. What is it? And the CMS project that you're saying will get commissioned later this year. What can it bring to the table in terms of revenues? Maybe for FY19, you can give us some guidance from this particular project.
The CMS project on a next year, a full year basis, it will give us around 120 crore sell, with at least 20 crore bottom line, and that is what we are hoping for. Next year, our target is around 750 crore. This year target for basic chemicals is around 750 crore.
Okay, so just to clarify once again, you had 600 crore of revenues in FY18 in basic chemicals. FY19 will look like 750 crore with a 120 crore contribution from your new CMS project, right?
That's right.
Okay. So what capacity utilization are you assuming for your new project?
New CMS project will start operating. See, new project will initiate from the end of this year. So only 1 quarter will be available for CMS project. Otherwise, because of higher ECU of caustic and chlorine, we believe that we will be able to reach around 750 crore rupees this year.
This year, all right. So next year,
this current year. So 18-19 is we are targeting 750 crore in basic chemicals.
Okay.
So next year should look even better then, right, sir?
So next year the target will be even 15-20% higher.
Higher than that. All right. Final question, sir.
That's right.
We have gone through 2 of your segments. Quickly, if you could tell us on your pigments business, last year you did a growth of around 12%, but margins, they saw some kind of compression. This year, what kind of a number you're looking at? You told us 15-20% growth in terms of a top line, but in terms of margins, can we see it stabilizing at around this 15%, or do you think there'll be some contraction or expansion from here?
I believe the 15% is practically bottoming out. We should be targeting for 70%. And the last year, what happened? The dollar went down. Dollar, which was 68 in the beginning of the year, came down to 64. So our realization went down, and crude prices started going up. So our energy cost, in multiple ways, from the raw materials to other raw materials, and of course the steam, etc., the cost gone up. So there was a margin contraction by 2% from 17 to 15. We are trying to regain from 15 to 70% this year.
Okay. All right, so we leave it at that. Thank you very much for joining in. That's the word coming in on Make Money Organics. Quite bullish on all the 3 key verticals. We'll get into a break. Then on that note, on the other side, Ashwini Gujral and Prakash Gaba join in with a few trading strategies.